This isn't just a temporary dip. It's a full-on reversal unfolding right before our eyes. Over the span of only 3 years, Florida's migration trend flipped dramatically, dropping from a net gain of around 310,000 new residents to just about 22,000 people moving in. That's an astonishing 93% drop in demand. The housing market is now taking a direct hit from that shift. Home prices have already started sliding, with declines ranging from 10% to as much as 25% in certain cities. At the same time, insurance premiums have surged out of control, climbing to anywhere between $5,000 and $10,000 annually for many homeowners. Foreclosures are picking up pace, while a growing number of properties are piling onto the market, creating a surge in available inventory. Homes that used to get snapped up within days are now lingering for 3 to 4 months, often requiring multiple price reductions just to attract buyers. This isn't random fluctuation. It's a system under serious strain, and the pressure is only beginning to build. At number 10, Ocala might appear steady at first glance, but beneath the surface, the data is starting to signal the early stages of a breakdown. Inventory hasn't just increased, it has surged dramatically, jumping by 66% compared to the same time last year. Meanwhile, the average time it takes to sell a home hasn't simply edged up. It has nearly doubled, climbing from 37 days to 73 days. That's not a mild slowdown. It's a clear sign that buyer demand has effectively been cut in half, even as supply continues to rise. When supply and demand start moving in opposite directions like this, downward pressure on prices becomes unavoidable. Some sources are still reporting modest gains of around 3% to 4%, yet data from Zillow is already indicating that prices are slipping. That kind of mismatch is a red flag. It suggests the market isn't moving upward uniformly, but instead beginning to fracture. A small portion of properties may still be holding their value, but many others are quietly losing ground without drawing much attention. Once that divide grows wider, overall averages tend to drop quickly and sharply. Looking back, between 2021 and mid-2023, Ocala experienced rapid price growth, with many homes increasing in value by 30% to 50% in less than 2 years. But that level of appreciation depends heavily on a steady stream of new buyers entering the market. Now, that flow of demand is drying up, as Florida's inbound migration has fallen from roughly 310,000 people to just 22,000, a staggering 93% decline in new potential buyers. On top of that, the cost of ownership has changed dramatically. A home priced at $280,000 with a 3% interest rate is an entirely different situation than the same home financed at 7%. Monthly mortgage payments have jumped by 40% to 60%, and that's before even factoring in insurance costs. In many parts of Ocala, yearly insurance premiums now range from $3,000 to $5,500, which adds an extra $250 to $450 per month for homeowners. That increase alone prices out thousands of would-be buyers from the market. So what comes next? Expect to see more homes hitting the market, more sellers cutting prices, and more properties sitting unsold for longer periods. Once inventory reaches certain levels, typically around 6 to 8 months of supply, the advantage shifts decisively toward buyers. Ocala is already trending in that direction, showing clear signs of that transition. This is how housing markets actually turn, not through headlines, but through the numbers. And at this point, the math in Ocala is no longer adding up. At number 9, Orlando. Orlando hasn't experienced a dramatic crash. Instead, it's hit a plateau, and that kind of pause is often where deeper problems start to form. On the surface, everything looks relatively steady. Median home prices are hovering in the range of about $375,000 to $385,000, appearing mostly unchanged compared to last year. But that sense of stability can be misleading. Data from Zillow indicates prices have actually slipped by roughly 4% from their peak in mid-2025. That means buyers who purchased near the top are likely already at a loss once you factor in closing costs, fees, and agent commissions. A more telling indicator is market liquidity, how quickly homes are selling. Properties that once moved within 45 to 60 days are now taking closer to 75 to 80 days to sell. That represents a slowdown of about 30% to 40% in transaction speed, which is a significant shift. In real estate, velocity matters. When homes stop moving quickly, Price reductions usually follow soon after. The real disruption, though, is happening with inventory levels. At one stage, Orlando approached nearly 8 months of available housing supply. That's far from a balanced market. It firmly places the advantage in the hands of buyers. Historically, once supply exceeds 6 months, sellers begin losing negotiating power. By the time it reaches 8 months, sellers are no longer negotiating. They're making concessions. Now add financing costs into the equation. A $380,000 home bought in 2021 with a 3% mortgage might have had monthly payments around $1,600 to $1,800. At today's rates near 7%, that same property now demands between $2,500 and $2,900 per month. That's an increase of roughly $900 to $1,200, or about a 50% jump in monthly expenses. Buyer demand doesn't easily withstand that kind of financial shock. Insurance costs only make things worse. Homeowners in Florida are paying 2 to 3 times the national average, with many Orlando buyers facing annual premiums between $4,000 and $6,000. That adds another $300 to $500 per month, pushing total housing costs beyond what many households can realistically afford. Orlando was one of the biggest winners during the migration surge. But when incoming population drops from 310,000 to just 22,000 people, the entire foundation starts to weaken. The steady flow of buyers that once supported peak pricing simply isn't there anymore. This isn't a sudden collapse. It's something more subtle and arguably more dangerous. It's a gradual erosion of value where prices fail to immediately reflect changing conditions. Sellers hesitate, listings accumulate, homes sit longer, and eventually the market is forced to adjust. Orlando isn't unraveling in an obvious way. It's tightening beneath the surface. And it's these quieter corrections that tend to catch people off guard. At number 8, Jacksonville. Jacksonville was often seen as the safe option, the more budget-friendly alternative compared to cities like Miami, Tampa, and Orlando. But affordability only holds up until the cost of living starts outpacing what people earn. And in Jacksonville, that tipping point has already been reached. Right now, median home prices are sitting somewhere between $280,000 and $290,000, reflecting a year-over-year decline of about 4% to 5%. At first glance, that kind of drop might not seem alarming. However, falling prices are just one piece of a much bigger picture. The real strain is coming from the rising cost of owning a home. Property taxes alone have jumped nearly 60% since 2019. That's not a gradual increase. It's a fundamental shift. For many homeowners, that spike adds an extra $80 to $100 per month, permanently increasing their baseline housing expenses. When you factor in insurance premiums now ranging from $3,500 to $5,000 annually, the total monthly cost of owning a home is climbing faster than wages can keep up. Looking at how the market is behaving tells an even clearer story. Homes that used to sell within 50 to 60 days are now lingering for 80 to 90 days. That's roughly a 50% increase in time on the market. As properties sit unsold for longer stretches, sellers begin lowering prices, not as a tactic, but because they have no other choice. Foreclosures are another warning sign that many people overlook until the situation worsens. Jacksonville is now ranking among the higher metropolitan areas in the country for foreclosure filings. This matters because foreclosures don't just impact individual homes, they drag down entire neighborhoods by introducing distressed sales that reset pricing lower. There's also a growing issue with future supply. Projections from National Association of Realtors suggest an additional 1% to 4% price decline through 2026, but forecasts tend to be conservative, assuming demand will remain relatively stable. And right now, demand is anything but steady. The slowdown in migration is hitting Jacksonville harder than many expected. It was never a primary destination. It functioned more as an overflow market. And when major markets begin to weaken, those secondary or overflow areas tend to lose demand first. Financing costs are adding yet another layer of pressure. A $285,000 home at a 3% interest rate once came with a monthly payment of around $1,200 to $1,400. At 7%, that same home now requires between $1,900 and $2,200 per month. Once you include taxes and insurance, Many buyers are now facing total monthly costs exceeding $2,500 for a property that was originally considered affordable. Jacksonville isn't experiencing a sudden collapse. It's being steadily squeezed from all sides, with pressure building over time. And when affordability disappears in a market that was built on being affordable, there's no cushion left to support home prices. At number 7, Port St. Lucie. Port St. Lucie was built around a straightforward idea. Leave South Florida, spend less, and get more space for your money. That formula, however, is starting to fall apart in real time. Home prices are currently hovering between roughly $395,000 and $410,000, while the median household income sits closer to $75,000 to $80,000. That pushes the price-to-income ratio beyond 5 times earnings, which is far above the traditional affordability benchmark of about 3 times. When that gap stretches this wide, demand doesn't just ease, it tends to break sharply. Inventory is where the pressure is most visible. The number of listings has surged to some of the highest levels the city has ever seen. At the same time, homes are now sitting on the market for 85 to 90 days, or even longer. Just a couple of years ago, properties were typically selling in about 40 to 50 days. That's nearly a doubling in selling time, and it points to one clear shift. Buyers are pulling back. Prices are already beginning to respond. Year-over-year declines are showing up in the range of -2% to -3%. But that's just the early phase. Price corrections rarely start with steep drops. They begin with slowing momentum, increasing supply, and quiet price reductions. Now consider the rising cost of ownership. Insurance premiums in the area are climbing toward $4,000 to $7,000 per year, which adds roughly $300 to $600 per month. Property taxes are also trending upward, adding even more strain. When you combine those costs with mortgage rates near 7%, the total monthly payment on a $400,000 home can easily surpass $3,000. That figure is critical because a buyer typically needs an income of around $110,000 to $120,000 to comfortably afford that level of payment. The average household income in the area falls well short of that range. As a result, the gap between home prices and local incomes continues to widen, and markets don't function well when that disconnect becomes too large. There's also an ongoing supply issue. New listings are still entering the market at a high pace, meaning inventory isn't leveling off. It's continuing to grow. And it's growing at a time when demand is weakening, which is exactly the environment where price declines tend to speed up. Port St. Lucie hasn't suddenly lost its appeal, but the underlying numbers are no longer supporting the story. And when the math stops working, the market eventually follows. At number 6, Lakeland. Lakeland isn't experiencing a sharp drop in prices, at least not yet. Instead, it's dealing with something potentially more concerning: pressure quietly building beneath the surface. Home values are currently holding in the range of about $305,000 to $320,000, which gives the impression of stability. But that sense of steadiness can be misleading when the underlying fundamentals are starting to weaken. Lakeland has recently posted one of the highest foreclosure rates in the country among mid-sized metro areas, with roughly 1 out of every 170 housing units facing a foreclosure filing. That's not just background noise, that's a sign of deeper, system-wide strain. The root of the issue goes back to the housing boom. Between 2021 and 2023, Lakeland became a hotspot for investors. Properties were snapped up aggressively for flipping and rental purposes, often at elevated prices and with very little margin for error. That kind of strategy only works when prices are consistently rising. Once appreciation slows down, the entire model starts to unravel. Rental demand is already beginning to soften, which adds another layer of risk. At the same time, mortgage costs have jumped by 40% to 60% due to higher interest rates. That combination quickly squeezes investor returns. When investors can no longer generate reliable cash flow, they begin to exit, and those exits add more supply to the market. Geography also plays a role here. Lakeland sits between Tampa and Orlando, often requiring commutes of 60 to 90 minutes each way. During the boom, buyers were willing to accept that trade-off in exchange for lower home prices. But as fuel costs rise, time becomes more valuable and job flexibility changes, that compromise starts to lose its appeal. Demand weakens, not because Lakeland itself has changed, but because the assumptions that once made it attractive are shifting. Meanwhile, inventory continues to climb steadily, and homes are taking longer to sell. Properties that once moved in under 45 days are now sitting for 70 to 80 days. That slowdown in transaction speed is a key signal, as it typically comes before downward pressure on prices. Foreclosures only intensify the situation. When distressed properties hit the market, they don't just sell, they reset pricing expectations lower for surrounding homes. A single foreclosure sale can drag down the value of multiple nearby properties, accelerating declines across entire neighborhoods. Lakeland's challenge isn't an immediate crash, it's the accumulation of multiple pressures: rising inventory, weakening demand, investor pullback, and increasing foreclosure activity. Prices haven't fully adjusted yet, but all the conditions that typically force that adjustment are already in place. At number 5, Fort Myers. Fort Myers isn't just going through a typical market correction. It's facing multiple layers of strain all at once, including structural, financial, and environmental pressures. Let's start with pricing. Median home values are currently sitting in the $370,000 to $390,000 range. But that headline number doesn't tell the full story. In certain areas, especially closer to the coastline, prices have already fallen by 10% to 15% from their peak, with some neighborhoods seeing even steeper drops. That kind of uneven movement isn't a sign of recovery. It points to instability beneath the surface. Now shift focus to insurance, which is where Fort Myers really stands apart from the rest of Florida. In the Cape Coral-Fort Myers metro area, annual insurance premiums are now averaging $8,000 to $9,000 or more. That translates to roughly $650 to $800 per month, often higher than the principal portion of a homeowner's mortgage payment. In some situations, total housing costs have surged by 70% to 100% compared to levels before 2022. That kind of increase simply isn't sustainable over the long term. A major factor behind this is hurricane risk. After Hurricane Ian, insurance companies reassessed their exposure much more aggressively. At the same time, updates from Federal Emergency Management Agency, particularly changes to flood risk ratings, continue to push premiums higher year after year. This isn't a temporary spike in costs. It's a long-term reset in how risk is priced. Markets don't adjust instantly to permanent cost increases. They tend to lag behind and then eventually correct. Inventory is adding even more pressure. Builders in the area never fully pulled back, and new construction continues to hit the market. That means supply is increasing right as demand is weakening. When buyers have more choices, resale properties lose their negotiating power almost immediately. That's why many existing homes are now sitting on the market much longer than new builds, often taking 80 to 100 days or more to sell. Financial stress is also becoming more visible. Some builders and sellers are already cutting prices by 5% to 10%. Others are being pushed into short sales, offloading properties for less than what they owe just to get out. That's not a strategic move. It's a clear sign of distress. When you put it all together, falling values, soaring insurance costs, rising inventory, and ongoing storm risk, the picture becomes clear. Fort Myers isn't stabilizing. It's being fundamentally repriced. And when a market undergoes that kind of aggressive repricing, it rarely stops at modest declines. It adjusts fully to align with the new reality. At number 4, Northport. Northport isn't simply experiencing a downturn, it's actually at the forefront of it. Among metro areas across the United States, this region has recorded one of the steepest year-over-year declines in home values. According to data from Zillow, prices have already dropped by roughly 9% to 10%, and projections indicate there could be an additional decline of 7% to 9% heading into 2026. That's not just a routine correction, it's a clear shift in momentum, moving in the wrong direction. But pricing is only part of the story. Market liquidity has taken a major hit as well. Homes are now sitting on the market for 100 to 110 days or longer, which is more than double the pace seen during the peak years. Once a property takes over 3 months to sell, it's no longer a seller's market. It becomes more of a stalemate, with buyers holding the advantage. Inventory levels are also entering risky territory. In some parts of the metro area, supply has climbed past 8 months. That's well beyond the point where prices typically start to fall more rapidly. At that stage, sellers aren't just competing. They're actively undercutting one another to secure a deal. The condo segment is where the pressure becomes even more intense. In Sarasota County, attached properties saw double-digit percentage declines in 2025, all while inventory was rising at the same time. New regulations requiring structural inspections, along with increased reserve funding requirements, have driven HOA fees significantly higher. In many cases, those fees now range from $800 to $1,500 per month. That cost alone removes a large portion of potential buyers from the market. Insurance is another major factor. Like Fort Myers, this area faces substantial exposure to storm-related risks. As a result, insurance premiums are climbing into the $5,000 to $8,000 annual range, and in some coastal zones, they're even higher. When fixed costs rise this quickly, affordability tends to break down. Then there's the lingering impact of past supply. During the pandemic boom, developers and sellers flooded the market, expecting demand to remain strong indefinitely. But that demand has since faded. What's left is a surplus of inventory chasing a shrinking pool of buyers. Northport isn't just softening. It's transitioning toward a new equilibrium where prices must adjust to reflect higher costs and weaker demand. And that adjustment is still very much in progress. At number 3, Cape Coral. Cape Coral isn't just going through a routine correction. It's in the middle of unwinding one of the most intense pandemic-era housing booms in the country. Between 2020 and mid-2022, home prices skyrocketed by roughly 40% to 70%, driven by a surge in migration, low interest rates, and heavy investor activity. That kind of rapid, almost vertical growth creates a fragile pricing environment. It can only hold together if demand continues accelerating. And the moment that demand slows, the reversal begins. Now we're seeing that shift play out. In some parts of Cape Coral, home values have already fallen 10% to 20% from their peak, with certain distressed areas experiencing even steeper declines. The time it takes to sell a home has also stretched significantly. Properties that once moved in 30 to 45 days are now sitting for 90 to 110 days. That's a slowdown of 2 to 3 times in transaction speed, which clearly signals that buyers have pulled back. Inventory is amplifying the pressure. Listings have increased sharply, with some segments approaching 8 to 10 months of supply. At that level, the market doesn't stabilize. It turns highly competitive. Sellers start cutting prices more aggressively just to stay relevant. But the biggest shock comes from the cost of ownership. In the Cape Coral-Fort Myers region, insurance premiums are now averaging between $8,500 and $10,000 annually. That works out to about $700 to $850 per month. When you combine that with mortgage rates around 7%, total monthly ownership costs can easily climb to $3,500 to $4,000. Just a few years ago, that same home might have cost under $2,000 per month to carry. That's a 70% to 100% increase in total housing expenses, and incomes haven't kept pace. Investors are usually the first to feel this kind of shift. Rental returns are shrinking, vacancy risks are increasing, and many properties purchased at peak prices no longer generate positive cash flow. As investors begin to exit, they add even more supply to the market, which accelerates the downward trend. Cape Coral also faces significant hurricane exposure, which keeps insurance costs elevated and adds uncertainty for buyers. Each new storm season reinforces that risk and makes buyers more cautious. This isn't a short-term fluctuation. It's a structural reset following a period of unsustainable growth. And when a market that climbed as much as 70% starts to reverse, it rarely stops after just a 10% decline. At number 2, Tampa. Tampa used to be one of the strongest and most in-demand housing markets in the entire country. Today, however, it's shifting into one of the most stressed. The clearest warning sign is coming from foreclosures. Tampa now reports the highest foreclosure rate among major U.S. metro areas, with roughly 1 in every 1,300 to 1,400 housing units receiving a filing. That isn't isolated financial trouble. It points to widespread pressure building across the market. prices are already responding to that strain. According to data from Zillow, home values have dropped by about 5% to 7% year over year. But even more important than the decline itself is the direction of the trend. Momentum has clearly shifted downward, and when that happens in real estate, declines tend to speed up rather than level off. On top of that, costs have surged significantly. Property taxes in Tampa have risen by roughly 50% to 60% since 2019, which adds around $80 to $100 or more per month for many homeowners. Insurance premiums are also climbing sharply, now ranging from $4,000 to $7,000 per year, and even higher in areas with greater storm exposure. Then came a major external disruption. In 2024, Hurricane Helene and Hurricane Milton both impacted the Tampa region, an event scale not seen in over a century. In especially hard-hit coastal areas like St. Pete Beach and Treasure Island, prices fell by as much as 20% to 30% in certain segments. Those localized drops don't stay contained. They reshape expectations across the wider metro area. At the same time, inventory is rising while demand continues to weaken. Homes that once sold in under 40 days are now taking 70 to 90 days, effectively doubling the time on market. And as more listings enter the system, the market gradually shifts toward buyer control. Financing costs amplify the pressure even further. A $400,000 home that once carried a monthly payment of around $1,700 to $1,900 now costs roughly $2,800 to $3,200 at current interest rates. Once taxes and insurance are added, total monthly ownership costs can easily exceed $3,500. That represents a 50% to 70% increase in housing costs without any comparable rise in income. Tampa didn't just grow, it overheated. And when a market overheats, it rarely cools gradually, it corrects. What makes Tampa especially concerning isn't just falling prices. It's the combination of rising costs, increasing foreclosures, and weakening demand all happening simultaneously. That mix doesn't stabilize a market, it pushes it lower. At number 1, Punta Gorda. Punta Gorda isn't just going through a standard correction. It's experiencing a much faster and deeper breakdown than most housing markets in the United States. The key number tells the whole story. Prices are down about 25.3% from their peak in July 2022. According to data from Zillow, that means roughly 1 out of every $4 in home equity has been wiped out. A home that once sold for $400,000 at the peak is now closer to $300,000 today. That represents a loss of around $100,000 before even accounting for transaction costs, taxes, or maintenance. Liquidity has also collapsed. Homes that once sold within 30 to 45 days during the boom are now taking 100 to 110 days or more to move. That's more than a twofold slowdown, signaling that buyers aren't just hesitant, they're largely absent. At the same time, inventory is rising at exactly the wrong moment. Punta Gorda is now among the highest-ranked areas in the country for expected new listings relative to existing housing stock, meaning more supply is still entering an already saturated market. When supply keeps expanding while demand is falling, prices don't level out. They tend to drop faster. But the most severe pressure point is cost. Insurance premiums in the region are now reaching $9,000 to $11,000 per year, or about $750 to $900 per month. For a population that is heavily made up of retirees, that burden is especially damaging. Many residents are living on fixed incomes, often below $60,000 annually. When insurance alone consumes 15% to 20% of total income, the financial math simply stops working. Foreclosure data confirms the stress. In Charlotte County, filings have surged by more than 400% since early 2024. That's not a slow adjustment. It's a sharp spike in distress. And distressed sales don't just reflect market weakness. They actively push prices lower by resetting comparable values across entire neighborhoods. The migration boom that once supported this market has also collapsed. Inbound movement has dropped by more than 90%, falling from around 310,000 people to just 22,000 statewide. Without new buyers replacing those who are leaving or aging out, demand simply fades away. Punta Gorda was originally built on the promise of affordable Florida retirement living. lower taxes, cheaper homes, and a coastal lifestyle. But that promise is now colliding with reality: falling prices, rising ownership costs, and disappearing demand. This isn't just a slowdown, it's a structural breakdown in motion. And historically, markets that have already fallen this far don't tend to stop there.